Thank you. Thank you, Group Captain Vijay Kumar. And can we have a big round of applause for MMA? You know, in many of the forums that I'm part of, I don't think you have such a level of knowledge sharing as it happens in MMA. And this is a monthly feature of Read and Grow. And I truly associate myself with the theme that readers are leaders. That's the theme that MMA keeps talking about. And truly, it's only that we get more intelligent by reading and imbibing core values. So delighted to once again be in front and talking about another iconic book. And before I bring in my dear friends Loganathan and A.K. Narayanan, a couple of quick points. Both Narayanan and Loganathan are known to me for almost 2 decades now, and both are, you have 3 chartered accountants among the 3 of us here. And I think I dare say cumulatively about 60 years of investing experience among the 3 of us. So I'm sure there is a wealth of wisdom apart from the book that you will find here. So hopefully we'll be able to share in the next hour whatever we can out of that wisdom that we have gained. Having said that, I just want to put a context to why this book. Till 2000, we are roughly exactly around the time when COVID was announced about 5 years ago, right? 2000, March 3rd week was when COVID was really announced and the stock market plummeted. At that point in time, we had X number of investors in stocks and stock market and mutual fund. In the 5 years that has followed, that number has, if not doubled, gone up beyond. So what took about 50, 60 years to build as investment base, in 5 years has doubled. So there is a natural interest in investing, stock markets, and today you can open an app and just press a button and you can make an investment, right? It's as simple as that. But like Warren Buffett says, investing is simple but not easy. And that is so true. Because everybody can invest in stocks or mutual funds or whatever be it, but there is no guarantee that you will make a profit. And that is true as recent as 2 months back when the SEBI chairman then, Madhavi Buch, was addressing a seminar. She said 97% of all the people, retail investors who played the F&O market ended up losing money. That's a staggering number. That's a large number of population of people, youngsters, who are putting in hard-earned money, but ending up with a loss. So I thought this is a great way to demystify some of those concepts that are necessary for people who are investing to really get behind some ideas as to how to enrich themselves. And so that's the concept. And before I go, I wanted to kind of talk about why stock market investing is simple but not easy, right? Because of few things. One is that just as the time when somebody is buying into the market or the stock, let's say you're buying a particular stock, there's also somebody selling. And this is quite ironical in the sense that you are thinking that stock is valuable and you're buying, and somebody is thinking that the stock is no longer going to go up and probably selling. So it's this, both of these have to happen at the same time for a transaction to get done. So it's very, so each one comes into the stock market with a different thought process, different perspective. That's the first important thing. Second is, there is no clear guideline. Do you sell when the market goes up or when the markets go down? Or do you buy when stocks go up or go down? There is no clear understanding. There is no one right answer, one wrong answer. This is why, while it's easy to execute a trade, it's while it's simple to execute a trade, it's not easy. So coming back to this book, The Art of Execution, I'm going to give a small introduction about the author. Lee Freeman Shaw is actually a practitioner. He is a researcher, writer, mentor, public speaker. Most of all, he was into fund management. In 2012, he was ranked among the best fund manager, top fund manager, managing assets in excess of $2 billion across 5 equity funds and 5 multi-asset funds. Lee holds a psychology and neurosciences master's degree from the King's College London and is a certified mentor and trainer. Additionally, Lee is also a law graduate from the Nottingham Trent University and the investment management certificate from the UK Society of Investment Professionals. The formula that Lee adopted in his investment strategy was very simple. Over a 7-year period, the book actually draws from real life experience of over a 7-year period. Lee involved 45 of the world's top fund managers and gave them anywhere between $25 million to $150 million to invest on his behalf. And his instructions were very, very simple. He told them that they could only invest in 10 of their top ideas. At any given point in time, they needed to hold each of these portfolios into 10 of the top ideas. It seemed at the outset a foolproof plan that had to make a lot of money. After all, these are among the world's biggest and best fund managers. So what could go wrong? They were the best in their area of work. They were the best minds on investing. But at the end of the time, most of the investors' great ideas had actually lost money. Shockingly, a toss of a coin to pick a stock may have actually given the same returns as those of the stock picks that some of these fund managers had done. But despite being wrong most of the time, many of these investors still ended up making a lot of money. That brings us to the question, how could somebody be wrong in investing and still be profitable? The answer, therefore, lies in 2 parts of everything that we do. One is in knowing, the other is in doing. The doing part is the execution. So there is something different about these investors that they do while they execute their trades that makes it profitable in spite of many a times picking the wrong stock or making a loss-oriented purchase. So that's what we're going to explore more. I'm not going to let the cat out of the bag yet. We still have a long way to go on this discussion. With that, I'm going to bring my dear friend A.K. Narayan here. A.K. Narayan, like Mr. Vijay Kumar had mentioned, is a seasoned investor, one of the founding team members of Tamil Nadu Investor Association, a man who walks, talks and breathes investing and stocks and so on and so forth. With that, I want to get his initial reactions on this book and what he thinks. Over to you, sir.
Thank you. Thank you, Babu. And good evening, all of you. Thanks, MMA Group Captain, Mr. Venkatraman, for inviting me to be one of the panelists among the elite, Mr. Babu, Krishnamurthy, and Lokanath. I'm really privileged and have a proud moment today to share my few thoughts. I always believe, of course, I'm an author of a book. Reading is one of the best things one can do for many things, and all the more is important while investing. Whenever I go to a college, I always tell them that you have to read Economic Times or Business Line or Financial Express, one of the papers, to get to know what is happening, but many of them are little busy and unable to spend their time. Having said that, this book, like what Babu has made a wonderful introduction about this book, is a seasoned man. The author has made a good progress about various types of investors. If you really look at the cross-section of the investors today, everybody wants to have their portfolio do well. But what is happening today, if you look at our portfolios, we are not satisfied at all. We buy either at the wrong time or we sell at the wrong time our shares when we invest money, or while investing in a mutual fund, we somehow tend to buy it at a wrong place. So all these things are happening. So this author also says many topics in that. He calls somebody a rabbit who, according to him, these investors never be successful because of their bad trades. So different traits of investors are brought in this book in a nice manner, and ultimately he says it's all about execution of a trade, like what Babu said. And one place I could also read, the execution is the key for shares buying or selling. Likewise, in real estate, the location is the key. If you buy it at the right place, you are going to have a real good boom period. Likewise, execution is the key for share market. But we do not know which is top and which is low. That's the problem here with us. We are under the impression the market has gone up today thanks to last 2-3 days run up. So we tend to believe that the bullish market is going to go forever. But it is not going to happen. That is what one should understand now. Today, what I am seeing is every investor wants to look at his portfolio not day to day, but minute by minute, and think that they are making money. Everybody has become glued to their portfolio minute to minute. It's a very sad story. We are not supposed to look at that. You buy a piece of land, leave it for 20 years, 30 years. You buy gold and keep it in the locker for many years. You don't care about what is happening. But when it comes to shares, you look at it minute to minute, and then you tend to think that market is crazy, it has gone down or go up. So that is the first fundamental mistake which is happening in the overall market. In my opinion, my initial thoughts of this book is one has to tend to read the book and to see what kind of investor are you in this scenario. Some people are really disciplined investor. I think the focus in the book is, he says you must be a regular investor, a disciplined investor, a person who is having a diversification in your portfolio. All these things, whatever we say as a financial planner, holds good in any book. The investment books are not going to be different, I can tell you for sure. Even if I'm going to write another book, the principles are going to remain same. Look at long term and patient. These are the two virtues of investment. But we are not able to follow that. When I say buy it for long term and wait for long term, people are saying how long? Say 3-4 years, 5 years. No sir, I want to redeem it after 1 year or 2 years. It doesn't happen that way. Why different asset classes? We have different way to look at it. After all, we are having only 4 asset classes, understand that very well. We are having fixed income, gold, real estate and equity. No other class we have today. Only 4 asset classes are there. And why we should evaluate equity in a different way altogether and say it is a risky asset. It is not at all risky, but you should know how to tame it, how to work towards that and then do it. So this book talks more about how a person can invest money. A different yardstick is not required for you to do it, and then in a calculated way, if you take a risk, you will definitely do it. So these are all my initial thoughts, Babu.
Thank you, A.K. Narayan. I'm going to bring Lognathan in. Lognathan, you've been a kind of a finance person. You have been in markets and for many years. In that context, if you can give us what your initial thoughts on this book and kind of how it resonated.
Sure. Thank you, Babu. Can you hear me, everyone? Yeah, good. Thanks, Babu, for inviting me. I've known Babu, as he said, for a long time. So it's nice to, be along with him on this stage. Thanks, MMA, for giving us this opportunity. Really appreciate it. Thank you, Group Captain, for your invite. Thank you all for coming. So before we start off, and get into the book, I would like to know how many of you here are investors? Wow, that's very good. That's a good number. So you're all investors in individual stocks or investors in mutual funds or a combination of both? Both. Wonderful. So then I think, we can really have a very interactive session. So fine. Before I delve into the book, just one disclaimer. I'm obviously from Sundaram Mutual Fund, but whatever I'm saying here is just my thoughts. It's got nothing to do with what the fund house is doing or, whatever experiences I relate are solely mine. Okay. So with that disclaimer, I will, start off in terms of what really was the takeaway for me from this book. So in 2 words, I would say was what the author says, materially adapt. And that to me was, one, it's really a very good investing lesson, but it is also a life lesson. Because in most of our, day-to-day lives, almost every other time, we have some hurdle. Something comes up. There is always something, and it is a question of how do we react to it? How do we materially adapt to this change situation, which is an adverse situation? It is a good situation, well and good. And that is what distinguishes successful people from the not so successful people. It is all about how you react. And he says that is the most important thing. So to me, if I had to capture this book in 2 words, Babu, it is about materially adapting. And here he says, what is materially adapting? He says that you bought a stock today, next week it is down 20%, what will you do? Okay, and that is when, everyone becomes a rabbit. As Mr. A.K. Narayan was saying, he distinguishes, the investors into 4 or 5 tribes. One of those is called the rabbit. And as you can well visualize, the rabbit is the least successful, because the rabbit, once it is caught in the headlights, it freezes. And typically, most investors do the same thing. I would say about 90% of the investors typically freeze. So he says that, and how do you overcome this? And his is very nice. He says that you should not take a decision at that point in time, because whatever decision you take at that point in time will be wrong. Because you're now so emotionally, distraught because your stock is down, the money is down, you have no idea what to do. So he said you should take the decision beforehand. And to me, that was very, very, enlightening, because it's a new insight saying that when you enter, come in with a plan. What is it that you will do if the stock falls 10%, 15%, 20%? And he says that not acting is not an option. You cannot not act. You will have to act. Either you will have to buy or you will have to sell. Continuing to wait, he said, is the biggest mistake you can do. And then he cites a lot of examples where he said that of all the losing investments, as Babu was saying, most of them are losing investments. Only a handful of them made money. Only of the losing investment, only 3% made money by trading. So which means pretty much everyone else froze. And here we are talking of professional investors, professional fund managers who are extremely wealthy, who made a lot of money. And if that is their case, then imagine what a layman investor who's put his hard-earned salary how is going to react. So to me, the point was that, materially adapt, and then have a clear plan. Then have a plan and then execute it. How do you execute it? Again, he says, automate it. All right. If the stock, you should have a clear idea. If the stock is down 20%, I'll either sell or I will buy. If it is a sell, he says, put in a stop loss. Sell it, get out, and then think afresh. If it is a buy, again, you put a stop loss, at that point it will buy. So that he says, take the decision making out of your hands at that point in time. The decision making should be made earlier. So I think to me, that was really the takeaway, that materially adapt, which I also find has far reaching implications in our day-to-day life and has a lot more implication when it comes to investing.
Fabulous. Thank you. Thank you, Logan. I think that's a splendid thought. Materially adapt to every situation, especially in life and in stock market. No 2 moments are the same, and it's very important to keep adapting. And we all are in this room proof that we have all adapted. Through COVID, we have kind of continued to adapt to a different lifestyle, and then we have come back successfully back to things. So those are all examples of how we have adapted to newer situations and thrived. So yes, that's what is one of the tenets of this book. But before I go, I just want to reiterate the point which Loganathan made. He said most of these fund managers lost a lot of their trades. And a couple of months ago, I saw a snippet of Roger Federer talking at a graduation ceremony, and there was a very, very nice YouTube video that I saw, which says, in his entire career, Roger Federer had lost 52% or 54% of all the points that he had faced, right? So he is the world champion for the longest time, and we would expect that he would have got so many of his strokes as winners. He says, in spite of losing 54% of all the shots I ever faced, I still became the champion. And that is what Lee Freeman is also kind of talking about. He says the best of fund managers also get things wrong. Not very dissimilar to you and me. Only thing is, when we get things wrong, like Loganathan said, like rabbits, we sit tight. We get caught. We don't know whether we have to buy more or sell more. And that's where the difference between a professional fund manager and somebody who is a novice comes into play. He says, you need to act at that. And in Roger Federer, he says, the moment I lose a point, I forget about it and focus on the next point, next opportunity to make the next point. And that's how he became a world champion. So, in some sense, the nugget that I derive is that don't focus on what has already happened. Look at how the next one you can make it successful, next one, so on and so forth. Having said that, I just want to bring a context. This book talks about 5 different behavioral traits of each of us in some sense, but he has alluded to investment managers, right? And like Loganathan mentioned, rabbit is one tenet of an investment manager who kind of does an investment with a preconceived thought, and then when things go wrong, he continues to stay put without reacting to it, hoping against hope, praying that the situation itself solves itself. And that rarely happens. And then he talks about 5 different other traits. He talks about people who he describes as assassins, people who describes about as hunters, then raiders, and last he talks about connoisseurs. I'm going to bring A.K. Narayanan and Loganathan after a little while to talk about which style do they relate themselves to, or which style they believe they have experienced in their life. But before that, I'm going to talk about a little bit about the connoisseur style, which kind of, I think, in some sense appeals to me and is something that I kind of tend to relate to. Now, connoisseur is a successful investor, right? And like any connoisseur, or for a simplicity's sake, let's say a connoisseur of wine, right? Typically, if you notice on a table, there is a connoisseur of wine, he doesn't gulp the wine. He looks for the finest wine on the table. He takes that wine, he smells, he kind of swirls it, and he takes a tiny sip of it. And then he kind of experiences in his mouth. And over a course of the entire evening, he will have half a glass of wine. And that's all the wine he will drink, of the finest wine. But the entire evening, he'll take small sips of it. And to me, the example that Lee Freeman talked about as the connoisseur investor related very, very closely to that connoisseur of wine that I am used to. He says connoisseurs find unsurprising companies, right? Companies which the average investor has not yet seen, has not yet experienced. So these are companies that are not yet in the limelight. They are not yet discovered, so to say. So he does a homework, he finds beauty in the ordinary, let's put it that way, right? So he has done his homework, deep conviction and faith that this company will kind of perform well. And as a connoisseur, he is not contented with small returns. He is looking for what we call in the investment parlance a multi-bagger. What do I mean by multi-bagger? Even when I'm investing in that stock, I am saying for every 1 rupee that I put in, I want the outcome to be 5x or 10x. So when I get the money back, it must be 10 times my investment value or 5 times the investment value. That's how I'm going into that portfolio. I am looking at allocating a reasonably large chunk of my money. So let's say I have 1 crore rupees. I am not buying 50 shares of 2 lakhs each. As a connoisseur, I am probably looking at 3 stocks where I'm going to put 30 lakhs, where I have high conviction these stories will work, rather than spraying my money across a lot of companies. And if for some reason, like what's been happening in the marketplace in the last couple of months, the stock market did take a tumble for a variety of reasons, whatever. The stock which I believed would give me 10x is down now, maybe to 40% down or 30% down from the value I bought. I am willing to do homework and buy some more. I have money outside. The author calls it gunpowder, to buy more of the same stock because I hold high conviction. If I was buying that stock at 100 rupees and for some reason the stock is now down to 60, why wouldn't I buy more? It's a 40% stock market discount available. As we do in a shopping, I would want to go and pick up some more of that stock. So that's the conviction with which he enters the buying story. And a connoisseur is somebody who comes into an investment with a pillow. That's what Warren Buffett used to say. Somebody asked Warren Buffett, what's the holding period for your stock portfolio? He said forever. Right? While most people who invest in stock market come with a 1 year, 2 year, 5 year horizon, real big investors who want to make it big come in with the idea that I want to stay invested. As long as the company is doing what it's supposed to do and what I think it should do, I have an indefinite period of holding in that stock. That is what he describes as a connoisseur investor and one of the finest investors who have managed his portfolio. And I think that I am able to relate to. And you had n number of instances in the past when some of the stocks were badly down and there was great opportunity for people to pick up, yet most people didn't go there. And those stocks today in 4 or 5 years are up 4x and 5x times, right? It's clearly something that I'm able to relate based on what I have seen of stock markets and stock investing. I'm going to pause here. I'm going to bring in A.K. Narayan. I'm going to ask him which of the traits he is able to relate to, and if he can, from his experience, talk about one of those traits or give us an example or insight into that, that would be great.
Thank you. I also started investing since 1984, so long time back, and I started accumulating shares of different companies, whether through IPO or through the secondary market. The 84, 85, even SEBI was not born. So what happened was there is no regulation and things were in a very disarray. But some of the IPOs which I invested at that point of time, even today, if I look back, it has done extraordinarily well. For example, I don't know whether you remember, there was a company called SKF in those times. They used to manufacture iodex. So that company, or the SKF, came in public issue at 8 rupees premium with 10 rupees at face value. I applied 2-3 applications. That time people make in the family name and all that. So I got about 50 shares of allotment. You'll be surprised. Even today I'm holding that share since 84. Because I thought, why to sell that? Because they're giving 5,000-6,000 dividend every year. And it got merged with Glaxo, Burroughs Wellcome. Now it becomes SmithKline Pharma. And the number of share also has gone up. So this is one set of example I can always give you. But during the internet boom or whatever you call, that boom of 2000, so many examples were given to people to buy left, right and center. And some of the shares really went so high, I can't believe it. Some of the shares which we bought went on. You said 5x, 10x. I still remember there used to be a company called Visual Soft from Hyderabad. At 10 rupees when we purchased the share, I thought 10x, whatever you're saying, 100 is a great sell. But then, when I sold it at some rate of 2,000 rupees or something, it went on to hit 10,000 rupees. Then I don't know how to, where will you place in this book? I don't know what kind of investor, you said 20x, 10x is a great thing. So likewise, at every stage, there were companies coming like this. But one good thing which I used to follow is you need to buy companies with good management, and corporate governance is the key. This is what I used to tell people. If the promoter is good, integrity is good, the product is good, and if the profitability is in par, please buy that share. But otherwise, don't look at that company at all. That is what I used to preach people, and that has helped me a lot. I remember still when during our association, Tamil Nadu Investor Association meeting, every alternate Sundays we used to meet. During Harshad Mehta time, every Sunday we used to meet. And huge gathering will be there. I'm talking of 1992, 93, 91, 92. 200 people will be there till 1:30 to find out what Harshad Mehta's tips are, latest tips. And once he came to Chennai and he went into a time house, so everybody thought he's buying some share, and a lot of requirement, a lot of people are buying that share. That's how people are. And I don't think it has changed a great today also. That is the story of it. People want to make quick money. This is not a place to make quick money. That is what I'm telling again and again. If I'm saying relating the figure of 1984 and 94, the idea to tell you all is equity is an asset class like any other asset class, but buy it, keep it for getting a decent return, and don't look at phenomenal return and don't think you can become a rich man overnight. So this is what this book also says. If you're going to lose 10%, 100 rupees you buy, you come back to 90 rupees. To recover that, you have to break even itself, you have to get another 11%. And if you're going to lose further 30%, then you have to make up 50%. And if you lose 50%, he says 100% you have to make up. That means the share has to come back to that level. So don't wait like a rabbit and don't stay on with holding on to the share. If you know that prices have come down by 20%, the best option will be to cut off, sell it off, and think it's a bad experience. If you can do that, I think you